The team at Daily Trade Alert, which is a sibling of this Dividends and Income channel, produces a monthly special report called The 9 Best Stocks to Own Right Now. The list doesn't change much from month to month because of the really high quality of these stocks. Greg Patrick, who is the co-founder and president of both of these outlets, picks the stocks. Then they are evaluated for dividend safety and business risks by Brian Bollinger, who is the founder of Simply Safe Dividends. In this video, I will show you the full list of stocks, and I will take the analysis a few steps further with quality snapshots, summaries of the reasons why each stock is included in the list, and also provide complete valuations for each of the stocks. Plus, there's one extra bonus stock for a total of 10. Hi, I'm Dave Van Knapp, appearing here for the Dividends and Income channel, and I would like to ask you to help us out by, if you like this content, clicking the thumb up, subscribing to the channel, and ringing the bell to get notifications when we post new videos, which is about once a day. And also, if you ring that bell, you'll get a notification if somebody replies to a comment that you made underneath the video. Thanks very much. Let's take a look at the factors that Greg considers in assembling this list of best stocks. He's looking for elite blue chip companies, high business quality, businesses that show resilience and consistency, maybe are dominant in their industries. Recession resistance is important, and that's often measured by how well did they do, not during the COVID recession of 2020, but during the Great Recession of 2007 to 2009. Obviously, to be a great company, you have to have great financials. Look at things like profits, consistency of profits, free cash flow, and so on. That's how dividends are paid, or out of cash flow. Look at the dividend record itself. The safety of the dividend, unbroken growth streaks of dividend increases, which often nowadays span into beyond 40, 50, and even 60 years. And finally, risks to the business. What could cause things to go wrong with the business? A factor that's not considered in assembling this list is valuation. It's based mostly on the business quality factors that I just said. I'm going to provide valuations though for each company so we can all get an idea of which ones are overvalued, which ones are fairly valued, and which ones are undervalued right now if you're in a buying mode. The beauty of owning stocks like these is that no matter what happens to their share prices, as long as the company's dividend is safe, then we, as shareholders, stand to collect larger and larger payouts each year, no matter what the economy or the stock market are doing. Here are the 10 stocks. Don't feel that you need to study them right now. I'm going to go through them, spending a minute or two on each company. Then at the end of the video, I'll pull everything together in a final display that will include quality scores, dividend statistics, and valuation. The first stock in the list of 10 best is Apple, ticker symbol AAPL. I've added a line at the top, 2 lines at the top of each of these quality snapshot tables to show you sector and the sub-industry for each company. In Apple's case, that is the information technology sector, and the sub-industry is called technology, hardware, storage, and peripherals. The quality snapshot I've explained several times in previous videos. I look at 5 trusted ratings from companies that I've come to trust. I assign them 0 to 5 points on each category. So there are a total of 25 points that a company can possibly get. And in Apple's case, it gets all the points, 25 total points, A+. Its Value Line Safety Grade is the highest grade in Value Line's system. The Value Line Financial Strength Grade is the highest grade in that system. The Standard & Poor's credit rating falls into the highest category of credit ratings. The Morningstar Moat rating is wide, which is the highest that can get. And the Simply Safe Dividend Safety Grade not only falls into the top category of grades, it is the highest grade that Simply Safe Dividends gives at 99. So every factor got 5 points times 5 factors, 25 total points is the maximum score. Okay, this display shows Apple's dividend record, and I want to bring a few things on it to your attention. Number one is in the top line. Its yield is only around 0.5%, so it's a very low yielding stock. It's only been increasing dividends for 9 years. That's as long as it's been paying dividends. And to repeat what I've already said, at the bottom you can see that it has the maximum safety score from Simply Safe Dividends at 99 out of 100. At this point, and I'm only going to do this while I'm talking about Apple, I want to show you a little bit of detail behind the dividend safety scores from Simply Safe Dividends. At the top of the slide in red, orange, light green medium green and dark green, you can see the 5 rating categories. Simply Safe Dividends uses a 0 to 100 point scale, and the safest dividends are rated 81 to 100. The next safest category is 61 to 80, and the next one is 41 to 60. And if you look in the lower right corner, we're going to call that the safe range for conservative dividend investors. And just so you know, that's where I stay with all of my investments. I don't own and wouldn't own a stock that rated below 41 on Simply Safe Dividend's safety scale. I'm not going to repeat that with each company. I'm just going to tell you that once, because you'll see the safety scores for every company every time I speak as I move through the companies, and there's no need to keep explaining the system behind them each time. This display shows why Apple is in the best stocks to own list. You can see the pros and the risks and negative on each of these slides throughout the video. I've held the number of pros to a maximum of 5, although I cheat a little by using bullet points under some of them. Just to quickly run down Apple, some of the positives about it. We've already seen its perfect safety score of 25. We all know Apple has a strong brand, and in this case, and whenever I talk about brands, the way I think about brands is that a brand is strong if an average consumer will go out of his or her way to go get that brand, walk across the street to a different store if they have to get the brand, rather than buying another brand or a generic unknown brand. Apple has great financials. They have big profit margins on the products they sell. They have more than $200 billion cash on hand. They have a smooth, growing cash flow generation machine. They're making steady share buybacks, which helps shareholders. And they have a low debt with a very strong credit rating. And you might know that Apple right now, by its market capitalization, is the most valuable company in the world with a market cap of more than $2.6 trillion. The risks and the negatives are not real significant, but just to say them. Apple's still highly dependent on iPhone success, providing more than 50% of revenues, but they have been working for years and moving quite successfully toward getting more revenues from services, subscriptions, and other products. It is possible, another thing to keep in mind, that their profit margins will erode over time as the industry evolves. And again, just to remind you, Apple has a tiny yield. So if you're in it for the yield, the income from Apple, Apple may not be the stock for you. All right, this display is another one that I'm only going to show once, so it's in the Apple discussion because it comes first. I want to show you how, or remind you, you've seen versions of this before, how I value stocks. Again, I use trusted sources, and in this case, those are Morningstar, Fast Graphs, and Simply Safe Dividends. I rate stocks valuation in different ways. For Morningstar, it's a discounted cash flow model. From Fast Graphs, it's a comparison of the stock's current price to earnings ratio to its 5-year historical PE ratio. From Simply Safe Dividends, it's the stock's forward PE ratio versus its 5-year average. And also from Simply Safe Dividends, it's a comparison of the stock's current yield to its 5-year average yield. Over on the right, I say the process is that I look all those things up, I adjust for outliers, and then basically average them out. The next area down shows how I value the stock by looking at its price. I basically divide its current price by its fair price as determined by the factors that I mentioned above. And then I divide that into 3 ranges. And for this video, I used a range of plus or minus 5%. So the fairly valued price is 0.95 to 1.05 times the fair price. Overvalued would be more than 5% above the fair price, and undervalued would be more than 5% under the fair price. And I also convert that to yields. I simply convert the price to equivalent yields, and you can come up with a different way, and I think sometimes a more easy way to think about fair value is to say, is it yielding where you would expect it to yield given its price and dividend history. And again, I use 5% on either side of fair value for the fair value yield range. Overvalued if it's yielding less than 95% of its fair yield, and undervalued if it's yielding more than 105% of its fair yield. You might notice that things are flipped between price and yield. Price and yield are inversely related to each other, so that's why the numbers in those boxes change. They are the mirror images of each other, basically. Okay, again, that's the only time I'm going to talk about how I value stocks. From now on, for all the companies, I will simply show you the outcome of those calculations. Here is Apple's valuation as I calculate it. Its fair price range is $112 to $124, at which point Apple would yield between 0.7 and 0.8%. Apple's current recent price is $162 and its yield is just 0.5%. And for that reason, I consider Apple to be 37% overvalued right now. I've colored that in orange. I put the blue arrow far into the orange range on this slide. And if it were me, I wouldn't be buying Apple at this time at its current price. That's all I have to say about Apple. Let's now move along to stock number 2, which is Hershey, ticker symbol HSY. Its sector, consumer staples, is shown here. Its industry, of course, is packaged foods and meats. Hershey doesn't deal in meats, but they certainly deal in packaged foods. And you can see here that all the categories in the quality snapshot are green. 1 point deductions on 2 of them. Those are minor. Total quality points is 23 out of 25. Still what I consider to be an A quality company. Here's a quick look at Hershey's dividends. Things I would call to your attention on this slide are its low yield at 1.6%, its 12% increase last July, which was 5% more than its average 5-year increase of 7% per year, and again its high safety score of 93 out of 100 points on Simply Safe Dividends scale. Why is Hershey on this list? Well, number one, it has a high quality that we've seen. 23 out of 25 points. Hershey has very strong brands, and it's very recession resistant. In the Great Recession, which is basically 2007 to early 2009, Hershey's sales grew each year, and its price, while it fell 30%, compares favorably to the Standard & Poor's index, whose values fell 55% in that same time frame. And Hershey has great financials, positive cash flows, earnings up every year for the past decade, and high profit margins. The only real risk to Hershey's business is the evolution of consumer preferences that are moving increasingly towards healthy, natural foods. It's hard to argue that Hershey's foods are healthy and natural. And again, Hershey has a low yield at 1.6%. I created this display for Hershey because I wanted to show you some examples of what great financials look like when I say a company has great financials. In the upper left corner, you don't have to be able to read these slides. You can just tell by the shape what's great about the financials. The upper left corner shows earnings per share. Hershey is one of the few companies I've ever run into where this particular graph shows an increase in earnings per share every year that's shown on the graph. Typically and often companies' earnings, while maybe on a general upward trend, have their ups and downs from year to year. Not with Hershey. In the upper right corner, it's free cash flow per share. And while those don't go up every year, you can see that every year Hershey produces solid positive cash flows. The lower left corner shows return on equity, which is a measure of profitability. And the horizontal line across that graph, if you can't read it, it says above 15% is our preference for consumer staples. Hershey's record, you can see, is way above that. That benchmark comes from Simply Safe Dividends, which is produced all of these charts that I'm showing you, and I just think that these bar graphs are an excellent way to look at company financials over time because you can just see visually what's going on. And you can see that the lowest bar graph here was in 2015. Hershey had 40% return on equity, but in its highest year, a few years later, it had 100%. Last year was 59%, so it's way above the benchmark of 15%. And in the lower right, that's the shares outstanding. Hershey is rebuying and retiring shares. Again, that goes down, I think, steadily every year for the last decade. And a falling share count is helpful to investors because each remaining share becomes a larger piece of the whole pie. Here's the last slide for Hershey, shows the valuation. You can see the discount range, the fair value range, and the too much range. And unfortunately, for people that might be interested in buying Hershey, it's way overvalued right now. Its fair range top end is $174, but Hershey's selling at a share price of $224 as I record this video. It's yielding only 1.6%. Altogether, it's 35% overvalued, and just as with Apple, I personally would not buy it at this time. Okay, let's move along to stock number 3 in our hit parade. It's Kimberly-Clark, ticker symbol KMB, the well-known consumer staple that sells household products, most of them involving paper of one kind or another. You can see that Kimberly-Clark gets all green except in one category. Value Line gives it a financial strength grade of just A, which sounds great, but it's actually the third one down. So I deducted 2 points from the total score for that alone. And there are a couple other deductions. The credit rating is A, which is a very strong credit rating, but not the strongest in Standard & Poor's scale. Morningstar gives Kimberly-Clark a narrow, not a wide moat, so I deduct a point there. And I think the reason behind Morningstar's not giving it a wide moat is that in Kimberly-Clark's business, they are constantly fighting battles against generic brands and house brands and store brands. Nevertheless, Kimberly-Clark gets a total of 21 out of 25 points, which is still a green B, the way I look at it. Okay, moving along to Kimberly-Clark's dividends. A few things to note on this slide. The high yield, the 49-year dividend increase streak, the sort of low dividend growth streak. The 5-year dividend growth rate is 4% a year, and Kimberly-Clark's most recent increase, which was just in January, came in at only 1.8% a year. Kimberly-Clark is in mostly slow-growing, steady, necessary, essential products, but slow-growing markets overall. Okay, here are the pros and cons of Kimberly-Clark. Again, it had a high-quality snapshot score of 21. It has very strong brands. Just a few are listed here: Huggies, Kleenex, Pull-Ups, Cottonelle, for what are basically considered essential products in our economy. Kimberly-Clark has also displayed recession resistance. It may be slow-growing on the one hand, but on the other hand, during the Great Recession, its price only declined 34%, which sounds like a bad hit, and it was, but it's come back from that, and it compares very favorably to the S&P 500, which declined 55% in the same time. And another plus here with Kimberly-Clark is its good yield of 3.6%. On the risks or negatives side of the ledger, we see that the products facing competition from generic and store brand products. Most of Kimberly-Clark's future growth must come from overseas. It's very well established in the United States, but you may have read that we have a declining birth rate in this country, and a lot of Kimberly-Clark's products are aimed at youngsters. So that is I would call it a slight concern. And I mentioned the slow dividend growth rate coming in at less than 5% a year over the last several years. Okay, here's the last slide for Kimberly-Clark, its valuation. The fair price range is $120 to $133 as I see it. Kimberly-Clark is just a bit above that at $138, a recent price, and a yield of 3.4%. So it's 9% overvalued, and I colored that orange, but I have to tell you that there are times when I do valuations that I put a wider band than 5% up and 5% down for the fair price range. And if I had used a range that I have used in the past of plus or minus 10% from my fair price calculation, very high quality companies, which Kimberly-Clark is, its price right now would have fallen within that fair price band, and I would be telling you that it's fair priced right now, and that bottom area of the slide would have been colored yellow instead of orange. Okay, moving along to the next stock is Hormel, another consumer staple that you're probably all familiar with. Its dividend quality snapshot gets green scores across the board for a total of 22 points, which is just 1 point less than I would call an A. So I call this a B plus quality snapshot for Hormel. Things to note on Hormel's dividend statistics are its 50-year. Things to note on Hormel's dividend statistics include its 56-year growth streak, increased its dividend every year for 56 years in a row, including last November when it gave a 6.1% increase. Its 11% dividend growth rate averaged over the last 5 years, and the fact that its dividend growth trend I looked over the last 10 years, and I can say that it seems to be settling into the high single-digit range. So we're more likely to see ranges that don't quite meet its 11% per year record over the past 5 years, but rather are more like last year's 6.1% increase. Okay, here are some things to note about Hormel. Why is it in this list of stocks at all? Well, it had a high quality snapshot of 22 points. As with other companies that we've seen, Hormel has extremely strong brands, including Hormel itself, Skippy, Spam, Dinty Moore, and Jenny O. Hormel has lots of brands, and 40 of their brands have either number 1 or number 2 positions in their respective markets. And as with other companies we've seen, Hormel is strongly defensive. Its price only declined 15% in the Great Recession compared to the S&P, going down 55%. A couple of negatives or risks to mention: 10% of Hormel's business is in commoditized meats, where it has no brand power and no pricing power. Again, repeating something we saw before with Hershey, consumer trends are leaning towards non-packaged fresh products, which doesn't play into Hormel's strength, and its yield is low at about 1.9%. And now we come to Hormel's valuation. The fair price range, as I calculated, is between $41 and $45. Hormel right now is priced way over that at $53, yielding 1.9%, and I think it's 23% overvalued, and with that kind of overvaluation, I personally would not purchase Hormel at this time. Okay, let's move to the next stock. It's Procter & Gamble, ticker symbol PG, another consumer staple stock in the personal products and household products area. And here's another perfect score, 25. Top scores across the board for Procter & Gamble. A+ in quality. Here are PG's dividend metrics. Things to note on here would include its mid-range yield of 2.3%, 65-year straight of increasing its dividend every year, a moderate growth rate in the dividend increases, 5% and in that range per year. And again, the top dividend safety score of 99 out of 100. Here are the pros and cons about Procter & Gamble. We've seen the quality snapshot, perfect score of 25. PG is one of the strongest, most reliable businesses of all time, really. Its sales dipped only 3% during the Great Recession in 2007 through 2009. A few years ago, Procter & Gamble completed a transformation of itself. It had decided it had strayed too far into non-core brands, and it went through a 3 or 4 year process of selling off those brands, consolidating around its core strengths. It sold off 100 brands, about 15% of total sales, and reduced its cost 15% in the process of doing that. And that was a great change for Procter & Gamble. As old as the company is, it saw ways that it could significantly improve itself, and it did so. Procter & Gamble supports its brands with heavy spending on marketing and advertising, and the company has very good financials, excellent free cash, and again, to remind everybody, free cash is what dividends are paid from, and a strong balance sheet, which means it doesn't have a debt problem. A couple of the negatives on the other side of the ledger: many of PG's top brands and products are in slow growth categories. Its huge size, and this is really true of many of the companies on this list, its huge size makes it difficult to move the needle in growth. Here's Procter & Gamble's valuation, and again, we encounter an overvalued stock. I have a fair price range of $126 to $139, at which extremes PG's yield would be in the 2.6 to 2.9% range. But right now, it's selling for $161, yielding only 2.3%. And again, at this price, given those numbers, I would not be a buyer of PG stock at this time. Okay, the next stock in our hit parade is Lowe's, the home improvement store that you're probably all familiar with, ticker symbol LOW. We see one yellow grade. It has what I call a low investment grade credit rating from Standard & Poor's at BBB+. To say low investment grade doesn't mean low credit rating. That's still considered to be a solid investment grade, and that is a term that Standard & Poor's itself uses. A deduction on the value line safety grade, top scores in all the other grades for a total of 22 points. We've seen 22 before. That's a B+ as I look at things. Very high quality. All right, here's a quick look at Lowe's dividend metrics. Things to note on this slide would include the lowest yield at 1.5%, the consecutive increase streak of 59 years, that always takes me by surprise. I don't think of Lowe's as having been around that long, but it has, and it's increased its dividend every year for 59 years in a row. And the fast growth rate of its dividend, its 5-year average dividend growth rate is 18% per year, and its most recent increase last year was 33% last May. That's remarkable for a company of this size and age. Even though it has a lowish yield around 1.5%, I wanted to show you this slide. This is what a fast-growing dividend looks like, and it's really remarkable. You can see the statistics across the top right. It says last 20 years, 24% per year. Last 5 years, only 18% per year. And last year's raise, off the charts, frankly, at 33%. And the uninterrupted dividend growth streak at the bottom of 59 years. Okay, here are the pros and cons for Lowe's. High quality, 22 points out of 25 on my system. Lowe's has over 1,700 stores, and on average they carry over 30,000 products, which is amazing. They are trying to improve their appeal to contractors. Mostly they've been identified with home do-it-yourself workers. Home Depot has probably outstripped it in terms of appealing to contractors, but Lowe's is trying to catch up in that area. And they are in the process of improving store layouts, their displays, and their online sales platform, which is becoming more and more important in the home improvement business. Lowe's has excellent financials except for its debt level, which is high, and its share count. There's a continuing share buyback program going on with Lowe's, as we've seen with several other companies. With Lowe's, it's been quite remarkable. They've taken 39% of their shares off the market over the past 9 years. On the other side of the ledger, a risk or a negative certainly is the high debt level. Lowe's has a 94% debt to capital level. I prefer to see company more like 50% in that area. It's in a cyclical industry, so Lowe's fortunes rise and fall with the economy, and they will rise and fall with the economy in the future. That's just the nature of home improvements. It's discretionary spending, and people can move in and out of it as they choose, depending on how other things are going in their financial life. And again, reminding you that Lowe's has a lowish yield of 1.6%. And here's Lowe's valuation, and we have some good news here. I calculate a fair price range for Lowe's of $197 to $217 per share, or a 1.6% yield. Lowe's recent price is $197 and its yield is 1.6%. So Lowe's is right on the borderline where I have the blue arrow pointing between the discount range and its fair value range. So I invented a new color for that, a lightish green at the bottom, to show that it's a cross between yellow and the deeper green used for true discounted prices when I make these slides. Okay, let's move along to the next stock in this list of 9 or 10 best. The company is PepsiCo, ticker symbol PEP. PepsiCo is a very high quality company. It's once again in the consumer staples area. The sub-industry officially is called soft drinks, but in a moment I will explain that is something of a misconception about PepsiCo. We always hear about Cola Wars, Coke versus Pepsi, but PepsiCo is much more than a beverage company. You can see here it gets highest grades in every category but one, for a total score on its quality snapshot of 24 out of 25, which is an A. Moving along, here's PepsiCo's dividend statistics. Notice that this is a mid-yield, mid-growth stock. I think it's the first one that we've run into. Mid-yield, 2.7%, is about twice the yield of the S&P 500. And its mid-growth rate is in the mid to highish single digits, 7% a year, both over the last 5 years. And in February, it gave an increase of 7%. I consider stocks like this to be what I think of as a sweet spot of dividend growth investing. That's why I point out the mid-yield, mid-growth characteristic of, and not to be forgotten is PepsiCo is another company that's increased its dividend every year for decades, in this case 49 straight years. Here are Pepsi's pros and cons. We already saw its quality snapshot of 24 points, which is 1 point short of perfect on that scale. It's another defensive stalwart with a dominant position in consumer staples, food and beverages. In fact, its snack division, much of which is branded under Frito or Frito-Lay or Lay's, actually brings in more than 50% of PepsiCo's total revenue, which is why I can't agree with the classification of it as a beverage company, when in fact it's getting more than half its income, or its revenue rather, from the snack business. Again, it's a recession-resistant business. People tend to keep on buying things like sodas and potato chips during a recession. And it is another company with excellent financials, has a lot of cash, rock solid balance sheet, and it's very high profit margin business. We've seen one of these before a couple of times now. The consumer shift to healthier, more natural products is a headwind for a company like Pepsi, and it's generally a slow to moderate growing company because of the kinds of businesses that it's in and the saturation that it's achieved in many of those markets. Okay, here's the valuation on PepsiCo. I have a fair price range rather, of $149 to $165. Pepsi is selling for $172, which is 10% over that fair price in the middle of the fair range, and it's yielding 2.7%, which is just under my two much price or too little yield, which starts at 2.8%. But it's within 10% of its fair price for an extremely high quality company. And personally, the way I operate, I would consider buying it here, although I wouldn't go chasing after it at this price. With the market moving the way it's been moving in the last few weeks, by the way, a lot of these prices are coming down. A little inside baseball on this video is that I had to go through this morning and change several valuations and prices because they moved so much in the last few days after I originally prepared and created the slides that I'm showing you. Let's move along now to stock number 8 in our list, which is Johnson & Johnson, the healthcare giant, ticker symbol JNJ. And here we see another perfect score on a quality snapshot, highest grades in every category. And if you notice under the Standard & Poor's credit rating, I put a little asterisk there. J&J is one of only 2 companies rated by Standard & Poor's that has the highest credit rating it gives, which is AAA. That is a higher credit rating than it gives the United States, which is interesting. The other company, in case you're interested, is Microsoft. Microsoft also has a AAA credit rating, and those are the only 2 companies left in S&P's system that have that kind of credit rating. Here's a look at Johnson & Johnson's dividends. Again, we see a mid-yield, mid-growth stock. The yield is 2.5%. The growth rate is in the 6 to 7% range each year, including an increase this year of 6.6%. And just to repeat, it has the highest dividend safety score that it's possible to get at 99 out of 100 points. Here's a look at J&J's pros and cons. We've seen its perfect quality snapshot of 25 points. It is number 1 or number 2 in market share in most of its business lines. It's recession resistant as several other companies that we saw earlier. Its price declined 27% during the Great Recession, which is just about half of the decline in the S&P 500 at 55% during that time frame. It has diversified product lines and multiple income streams. It participates in many markets, which is always a good thing, I think. And it has excellent financials. I've already said it's one of only 2 companies with a AAA credit rating. It has a fortress balance sheet, consistent earnings, generates consistent free cash flow, and it has plenty of cash on hand. On the negative side, you are probably aware that Johnson & Johnson is under some pressure from both opioid lawsuits and talcum powder lawsuits against it. Although, upon analysis, I've come to the conclusion, and this agrees with Brian Bollinger's conclusion, that it's unlikely, those lawsuits and that pressure is unlikely to threaten the long-term outlook of J&J, given its huge scale and strength in so many businesses. J&J has a slow to moderate growth rate, and one thing we haven't seen before that's unique to J&J in this group of stocks, it has decided to split itself into 2 companies, similar to what Abbott Laboratories did about a decade ago when it split off its pharmaceutical business from its consumer business. That's what Johnson & Johnson is going to do. That should be completed, I think, this year, 2022. And each, when it's formed, we don't know the names of the companies yet, but each one it's formed will be a leader in its field. Okay, with Johnson & Johnson, we find another company that's very close to being fairly valued. I have its fair price range as $160 to $176. As I record this, Johnson & Johnson's price is $181, just $5 above the upper edge of that fair range, and it's yielding 2.5%, just 1/10 of a percentage point under where the too high a price range starts. And overall, running the numbers, I have Johnson & Johnson as 8% overvalued. And I would certainly buy Johnson & Johnson with its perfect quality score at an 8% overvaluation. I will go up to 10% for a company like this. But in the system I chose for this video, where I went plus or minus 5%, I have to call it overvalued, 8% overvalued. The next company in the list, the second last company in the list, is Starbucks, ticker symbol SBUX. You can see a little more variety in its quality snapshot scores. 3 categories came through with the highest score, but the S&P credit rating again comes through as BBB+, which is an investment grade credit rating, but not at the highest in S&P's scale. And this is the first stock we've seen without a dark green. I think it's the first one we've seen without a dark green dividend safety grade. We have the second category down in the 61 to 80 range, which still rates as green and safe. Total points, we've seen this total several times now, 22, which I give a B+ quality. Okay, here's a look at Starbucks dividend credentials. The main thing I want to point out to you here is that Starbucks is a mid-yield but faster growing stock. Its yield is 2.5% at the moment, but its growth rate over the past 5 years has been 17% a year, although last September's growth was 8.9%. Still kind of fast for the yield. Its dividend growth trend has been slowly decreasing to the high double digits, and I'm going to show you that in a moment. I made up this display to show you and talk briefly about Starbucks dividend growth situation. In the upper line that says Starbucks Corporation with several things highlighted in yellow, I want to draw your attention to the yellow highlights and ask you to read that line backwards, because that'll take you from its 10-year average dividend growth rate to 5-year, 3-year, 1 year, and then the most recent. And you can see that 10 years ago, its average dividend growth rate sat at almost 21%. And then as you go backwards through that line through shorter periods of time, it comes down to 16%, 11%, 9.5%, and last year's increase of 8.9%. If this were an older company struggling in its business, I would be concerned about a line like that. But I'm not concerned because Starbucks has only been paying dividends since 2010. So in a way, it's kind of finding its way as to what the right growth rate is for its dividend and for its business. And if you look at the graph, you can see that even though the growth rate has been declining, the slope of the line of the graph is pretty steady. And the reason for that is that each year the growth rate, the dividend growth rate percentage, is applied to a higher base that includes the previous year's increases. That's why a growth rate can be declining in percentage as the years go on, but the rate of increase of its dividend appears to be the same because the line is drawn in dollars, not in percentages. So the number of dollars being added each year is pretty steady, and it's nearly at a 45-degree angle there, as you can see. Here are the pros and cons of Starbucks. We've seen its high-quality snapshot of 22 out of 25 points. It has a relatively stable business. Sales dropped just 9% in 2009, the last year of the Great Recession, and we all know the reason why. While Starbucks is considered to be consumer discretionary, for a lot of people, it's not that at all. It is consumer staple. They need their Starbucks every day. I used to be one of those people, so I know what that's about. I've since switched to another dealer. Starbucks is fast growing. Its revenue grew 120% from 2011 to 2021, and it shows unbroken revenue growth over that same time period, except for a drop in 2020 when COVID hit. And we know what COVID did to all restaurants, and Starbucks was not accepted from that. Okay. Moving to the other side of the ledger, Starbucks suspended its share repurchase program in 2022 to reinvest back more into its business, including improving its location. I think that's a positive for the business. While I like to see declining share counts, when a company makes a capital allocation decision like that to stop buying back its shares to improve its business, usually that's a good move in the long term for the business. A risk to Starbucks is that it has an undiversified revenue stream. It basically sells one line of products and doesn't have these multiple lines that we've seen in so many other companies. I'm not saying that's a problem. I'm just saying it's something to be aware of as you analyze and think about Starbucks. And finally, Starbucks' continuing growth will become more challenging as the market becomes saturated, or God forbid, consumer tastes change and Starbucks loses its high-end standing among the various coffee purveyors that are in the markets everywhere. Okay, Starbucks is undervalued at the current time. I have its fair price as $98 to $108, but Starbucks is selling for $78, which has bumped its yield up to 2.5%. And by my calculations, Starbucks is 24% undervalued at this time, making this a great opportunity to buy shares in Starbucks if you like its business and its business prospects. Okay, let's move on to our 10th stock in our list of 9. This is actually a bonus stock. It's Medtronic, which is in the healthcare field. It may be the least familiar name to you of all the companies that we've talked about. It sells, produces, develops, creates healthcare equipment. You can see that its quality snapshot is 1 point short of being perfect at 24 points. An A grade. Its only single point deduction came again from its credit rating. That often is the case when I do quality snapshots, that a company's lowest grade happens to be from Standard & Poor's credit. Here's Medtronic's dividend resume. This is a mid-yield stock, 2.3%, with a fastish growth rate, 9% a year over the last 5 years, and last year's increase was just about that at 8.6%. And again, to repeat at the bottom, perfect dividend safety score of 99. Here are Medtronic's pros and cons. 24-point quality snapshot, rated A, a recession-resistant business. Given its product line of healthcare devices, its sales actually grew, and its cash flow also grew during the Great Recession. It was not a company that was hit by the recession very much. It has a disciplined acquisition strategy, which is important to note because a lot of Medtronic's growth comes from making acquisitions of smaller companies that are in the same product lines, or that it can make natural extension to its product lines by acquiring the company. And as with all the companies, it has good financials, steady growth in earnings, consistently positive cash flow, and very high and very stable profitability, operating margin. Its only risks to me come from making a mistake potentially in one of its acquisitions, either getting something that's a bad fit or that doesn't merge or integrate well with its current holdings. And just something to keep in mind with all healthcare companies, there's always government regulation in the background that the company may have to contend with sooner or later. Here's the last slide for Medtronics, and it's more good news on the valuation front. I calculated a fair price range for Medtronic of $113 to $125 a share, and a fair yield up to 2.2%. Medtronic's current price is actually $108, and it's yielding 2.3%. And for me, that makes Medtronic 9% undervalued at its current price. Okay, we're getting near the end of the video. I'm going to wrap things up and start out by saying that we, meaning those of us who create this content for Dividends and Income, believe that a great way to generate wealth in the stock market over the long haul is to, number one, buy a select group of high-quality dividend growth stocks, such as we've been talking about in this video, buy them at reasonable prices, hold them for the long term, and reinvest dividends along the way. That's how I run my own portfolios, both my public portfolio and my wife's and my personal portfolios, and we think that any long-term investor will do well with this approach to investing. Here's a summary slide of the 9 or 10, including the bonus stock, Medtronic best stocks to own, as presented for May 2022. And as I said at the beginning of the video, this list doesn't change so much because of the high quality of these companies. I've arranged this slide in order of the quality snapshot, which is to the right of the middle column on this slide. So the highest quality snapshot companies are listed first, and then down to the lowest one. The lowest one is still highly rated, Kimberly-Clark, with 21 points. You can stop the video at this point if you want to read the detail here. I've shown for each company its sector, its yield, its 5-year dividend growth rate, the quality snapshot score, the valuation, the recent price. On this slide, it's a shorter version of the slide you were just looking at. I've pulled out the undervalued or fairly valued stocks, and this time I've ordered them by their degree of attractiveness based on valuation. 6 of the 10 stocks that we went over today in the video are undervalued or no more than 10% overvalued right now. And for me, that means they make a nice watch list of stocks to possibly buy or add to. The ones that are undervalued are viable now, in my opinion, and the ones that are within 10% of being overvalued are all worth watching, especially with the way the market's been moving recently. They could go from 8, 9, 10% overvalued to fairly valued in 1 or 2 days of trading. And that's what we all do, is watch for those opportunities to arise. As to the other stocks of the 10, the other 4, I would wait on those to come into their fair value range before considering them. And with that, we're at the end of the video. Thanks very much for watching. Join the dialogue in the comment section underneath the video if you feel like contributing there, and I'll see you guys next time. Bye-bye.